Welcome to another episode of Close. Today, really excited to we flew you up from North Carolina.
Well, I'm here a lot.
To have Michael Cohen. He's the managing principal at Brighton Capital Advisors, where he's on the front lines of some of the most complex deals happening in commercial real estate right now. Michael specializes in what to me is a very scary phrase: commercial mortgage-backed securities and commercial real estate loan workouts, including recapitalizations, restructurings, navigating distressed assets. Michael and his team have advised in over $50 billion of transactions across multiple market cycles. And I'm guessing you're going to be advising on many more over the course of the coming weeks and months. Yeah. We'll talk about that.
Or year.
or days. Well, we're going to talk about what's happening behind the scenes right now in the mortgage-backed security world. And even though this is a real estate podcast, and a lot of the people listening to this, and including the hosts, have a vast array of knowledge when it comes to real estate, I think it would be helpful to kind of give us the guide for dummies to commercial-backed securities. So what are they? Why do they matter? And then I guess we can talk very briefly about what kind of threat do they pose in the New York City market and to the financial market writ large?
Thanks for having me. I started out in CMBS in 1991 after I got called down. I was doing real estate due diligence and workouts for the savings and loans when I was at Coopers and Lybrand, and they said, "Hey, we have an assignment done at Lehman Brothers for you to go down there, and they're securitizing RTC loan." And I said, "What's that?" And then figured out what the four CMBS really means.
Yeah.
And I will say that it is a necessary product for us in the market to have. It is a good product. It is something that if your loan is not going to have a lot of changes and you can repay your loan, then CMBS is one of the better executions you're going to get. You're going to get more leverage. You're going to have limited recourse to the carve-outs, and you're going to benefit from probably a better structure, interest only. The issues with it is it's immovable and it's very difficult to change. And once the loan is sold from your institution, whoever closed it, they don't have any control anymore. It's into a bond. And once it's into the bond, it becomes a bit of the interests are not aligned. You have no relationship. And I effectively call it a pawn shop because the servicers have all the rights and they're looking to gain fees and other things, and into that a little bit more. So
the loan's essentially a Frankenstein, right?
Yeah. Well, it started out that way. It's when I was I'm old, so in the 90s we were getting information in from the savings and loans on paper, and we were putting it into an Excel model, and it wasn't complete. So you really didn't understand it. So you were kind of making applesauce out of apples. Now the pools over the last 30 years have been more crafted. I started at DLJ in 1992, and then went down to start the conduit in First Union in 1996, and and then moved over to Deutsche Bank. And then after Deutsche, worked for an owner operator, went back to UBS to CMBS, and then into Citi at CMBS. So lots of experience, and I've done every part of the business. So from the beginning of making the loans and making the bonds to really running the Southeast and Mid-Atlantic. And when you go through recessions, you understand what people's issues are, so that when you come back, and especially after you work for an owner operator, you really see it. That was a big wake up thing for me. Yeah. So when I was getting back in 2020, I started this business. I saw exactly what was going to happen in terms of the delay of COVID. You can't delay something that long and not have repercussions. I didn't realize it was going to be this big, and it's bigger than even now than I thought. And I really wanted to help borrowers, to help them understand how to navigate through CMBS servicing and special servicing, because we need strong attorneys like yourself to be there and represent, to understand and help us to create what strategy we can do. Can we be aggressive, or do we have to be delicate because there's some exposure to recourse? What are the tax ramifications? We are not brokers. We're not tax advisors. We're not lawyers. We are a firm of advisors that are experience in CMBS and the different facets. One, me in business, another person who's been in legal and in the legal side of CMBS of closing loans and being in large loan special servicing, and another person that's been the same 25 years in CMBS special servicing. So we know what you should expect and what you know. So what we're providing you to is knowledge, and that knowledge is going to help you to create a workout situation and a solution for yourself. So I had this conversation today. It's really, people are like, well, how do you know what's going to happen? Well, some of it is just 30 years of bumps and bruises and being in these cycles. The last 5 years, I would say we have had tremendous success because we understand what and what can't get done. And we also understand that the lender does not really know everything that they need to know. So what we do is we put together a package which is comprehensive and includes all the things that the borrower needs to do. So let me step back for a second. As I said, CMBS started in 1991 for this very reason. And then it became such a hot popular topic and loan because it's non-recourse and you can get plenty of leverage that it really heated up all the way up to 2017.
Yeah.
That was really a year.
For those out there who don't know what that means, when you say non-recourse and get a lot of leverage, why does CMBS offer that opportunity to borrowers?
So CMBS is when you make a CMBS loan, you put it into a single purpose bankruptcy remote entity. And so there you have a sponsor who is guaranteeing the carve outs, and the carve outs are, and I'm not a lawyer, so I mean, they're generally for waste, for environmental issues, non-payment of taxes, misuse of insurance, neglect and fraud,
Yeah.
amongst the others. So real, what they call the bad boy carve out. So a lot of sponsors and a lot of people like that. Again, the trade-off is you don't have a relationship in case something changes. And when COVID hit, that was a material change. And that's another reason why I started this company. It's named after Brighton, New York, where I'm from, upstate New York. And so it's a place where we kind of appreciate each other and help each other out. So that was my goal here, is to help the borrowers out.
Yeah.
So CMBS right now, the big issue right now, and they're similar, but they're also very dissimilar in some of the asset classes. The biggest issue right now, because 2017 had one of the best coupon rates, the best loan dollars, the best, most favorable structure to the borrowers. Well, the volumes hit so high, but those were 10-year mortgages, and they're all coming due in 2027. All at the same time. And even that some were refinanced, there's still a number of them. To add to that tsunami of loans is the fact that many of the current loans over the last 5 years are getting extended. So that just pushes up that wall.
Right. The lenders have been kicking the ball down the road.
Correct. Correct. And I'll get into that, why that may or may not change in a second. But the key here is that it's a game of musical chairs right now, because if you're a certain product type, there's only a limited capacity for somebody to take you out. The biggest overall reaching and arching problem in this is kind of similar to the crisis of residential in 2010, is over leverage. Multifamilies by far have a very big issue right now. CLOs, which are collateralized loan obligations, which is a form of securitizations used mainly for loans that are being value add. So they need sometimes a bridge loans, having a difficult time. They were underwritten at a lower coupon, takeout at a lower coupon, higher rent and lower expenses. And none of those are coming true. So,
and rates have gone up.
So
in case you haven't heard.
and I think that, and one of the things is that rates, if all you can do is hope that rates come down in order to get to a new cap rate and a new value and a takeout, it's hope is an action, but it's a non-action.
Well, that's why these were all extended, right? There was the hope that the market would change, the rates would come down.
I think, and this is where the dynamics are going to change right now. We're in a situation where people were unsure what the market was going to do, whether it was going to go up or down, and didn't want to necessarily take a loss. So that when I say people, these would be banks and lenders. So they maybe made an extension and gave you an extension. Two things are happening right now. One is because interest rates are staying somewhat static, nobody's really happy about them, but it is what it is. I don't think anybody's predicting them to shoot down. In fact, I just saw the Fed, there's I think a 95%, I think BofA came out and said there's a 94% chance that you won't see a rate cut until maybe the fourth quarter of this year. Mm-hmm. And even so, based on inflation numbers that are out is pretty scary. So every time we lower something on the Fed, it kind of goes up in the treasuries. So if we assume that, and we assume a stabilized coupon out there, then that really predicts what the cap rate is. And once the cap rate's predictable, the markets can start to trade because you're not concerned that you're going to lose lose value the next day. So what does that do? That gives the lenders more leverage and power to go and foreclose on your loan and just sell it into the marketplace. So
is that starting to happen
now?
Yes,
it started to happen in the fourth quarter. We started to see it. I talked to a lot of the receivers and brokers from that firm. They were starting to sell it. It's not coming out in droves yet, but the lenders and especially CMBS are not hesitant now to foreclose. Now, the goal of CMBS special services is not to foreclose; is really to modify the loan, put it back into working order, and modify it, and then get paid at the end of the day.
Right.
However, the borrower doesn't have the leverage to do either one of two things. One, they can't say, you need to extend me, because they don't have to. And the other thing is the bank doesn't have to take your loan back if it doesn't want to.
Right.
And so there's a couple predicaments that you have to be aware of. And I find borrowers that the borrowers with the most success in CMBS are the borrowers that come to me 6 to 9 months prior to the issue arising, and that we can actually understand it, package it, get it ready, do the due diligence, and then make the presentation to the CMBS servicers.
So are you kind of advocating to the servicer for extensions and modifications? Is that the primary goal?
We are the borrower's advocate. And what we're saying is the borrowers, somebody's going to take a loss at some point, and we believe that if we can get past this time, that the property has value, and that the borrower is the best shepherd for this property. And these are the reasons why. And this is the structure that will work for both the borrower and you to get your money back.
Don't take 50 cents on the dollar through a foreclosure.
They won't. Again, there is not right now, because there's not a lot of volume of loans for sale in the market. The 50 cents on the dollar deals are getting bid up to 80, 90 cents. So there's not a lot of volume out there to do this with. I guess
it makes your job more difficult.
Well, it does and it doesn't. I mean, if you come to me, I'm going to ask you two questions when you come to me. Do you want to keep your property, and do you have money to invest in your property? And when I say invest, means I'm going to go in and we're going to structure a loan modification or extension, and we're not going to put your money. I'm going to advocate to say, I'm not buying this loan down at all. If you want to buy it, I'm going to put this in to be accretive at the property level. And when it's at the property level, you need certain controls and certain returns. So there's a lot of things. What the most complicated thing in CMBS for most borrowers is that there's so many rules and nuances and regulations that you really, and most of them are not logical because of the bond structure and what the tax ramifications and rating agency, that when we tell you need us to be a guide, you and the attorneys and the borrowers need us to be a guide to say, you can do this and you can't do this. But at the end of the day, what we do is we'll craft the solution, incorporating all of the borrower's needs into that solution to get it extended. And what the servicers like us, because when they pick up our package, they know it's complete. They know it's thoughtful. They know we're in the box. Like, I'm not going to go to the center of the box, but there's a deal to be had here. And look, you as a borrower, you have to be in CMBS. You have to be offensively looking to see if you can do something that will be accretive to the property and to help you to get through this issue. And simultaneously, you need to be defensive because the lenders have their rights, and they will put you to the test right away. Once you hit maturity default, do not wait to go and get to the special servicer and think that you're going to have a knife fight, because you're going to be pretty much tied up and handcuffed, and there'll be an anvil about 1 inch from your head, because the minute you go in there, you'll get the notice of foreclosure, you'll get the notice of everything that's happening, including a threat of receiver. The cash management will start, and the fees are going to start, and you're going to start seeing the fees, servicing fees. You'll start seeing default interest. You're going to have to post a deposit for legal fees. You really want to start this process early, because there's really three main components of a CMBS servicer, and that's probably a lot of people have to understand. The first servicer you're going to talk to is the master servicer. That's Wells Fargo or Trimont now. That could be PNC. That can be Midland. Those are your administrators. So they're the ones that you're talking to every day. Now, you may get on the phone and have a great relationship because they're great people, and think you're cutting a deal, but you're absolutely doing nothing. You're talking to them. You're talking to the maitre d' about what kind of, how you want your stake done. It doesn't matter. When you get transferred to the special servicing, and sometimes it's a challenge because you want to talk to a decision maker, is the special servicer will be the ones that are taking care of any changes to the deal any changes, any modifications or extensions. The twist here is that the lowest rated bondholder, the person that's in the bond stack that gets their money the last, is called the controlling class holder, and they have ultimate decision whether you get a modification or not. And the issue there is they have zero alignment with you, because they have other reasons as to why to give you something, and maybe sometimes to not give you something. Even if it makes logical sense, it could benefit them to not give you anything and keep the controlling position so that they can make fees on other deals at the expense of your deal.
Why do they have the controlling position? Is it just the statutory framework designates them as the control?
Yeah. So how CMBS works is it basically you could securitize anything. You can securitize cell phone towers. You could securitize credit cards, homes, car loans. It's a stream of payments that you're receiving. Now, CMBS is unique because there's a big lockout and a big penalty to prepay your loan. Unlike a residential mortgage where you could pay it off in a second, in CMBS you're gonna pay your full fare the entire way. And so what happens is when the principal and interest are coming in every month, it goes down the waterfall. The AAA bondholders get the first principal and interest, then it goes to the AA, single A, triple B, double A. It goes all the way to the very end. You'll hear a term called B buyer a lot. The B buyer means you made $1 billion worth of loans, and you gave it to the rating agency and said, okay, please cut them up into these tranches. And the tranches are really based on whatever the rating agency thinks that each loan with their metrics, their cap rates and their coupons and their debt service coverages equates to certain debt service coverages, certain LTVs. So at the end of the day, you might only get 900 million of rated bonds. That means that you have $1 billion worth of loans. So you have this mezzanine piece, this equity piece, this B piece, it is a strip at the bottom. And that's the biggest return because they're the last ones that get paid in the waterfall. So that's why the bottom people have a control, because if it was just a AAAs, it'd be like, okay, sell everything because my position is 50% loan to value, like sell it and I'll get my money back. No big deal. Right. So you want to have somebody in there. And at this point, and it's always been this way, but it's even more so, is that the B buyers right now are actually pre-approving the deals that go through every conduit loan. So we've been guiding our clients. We just do this for our clients, but we'll help guide them through the CMBS process if they need and want to get a CMBS loan, and give them the ins and the outs.
What do you anticipate is going to happen as we get closer to 2027 and all of these loans are maturing simultaneously, and we have this backlog of loans that have been extended? Do you anticipate just a rash of foreclosures? Do you anticipate more extensions? What do you think is the most likely outcome? I know it's somewhat
I think about this a lot because let me give you some stats of what's going on now.
But I want the prediction too.
I'm totally going to give you the
Don't
prediction.
hide behind stats.
No, I promise.
Those silly stats.
I told you you're gonna get a tingle up the back of your spine when I'm telling you this stuff, because this is not going to be a warm and fuzzy conversation. It's going to be what I am and realistic and what I'm seeing. So the predictions are really, for me, when I read tea leaves, I'm trying to look at fact patterns of what I see. I travel around a lot. I talk to a lot of people. I see a lot of deals. We cover the entire country and all the property types, speak to all the special servicers, all the receivers, and we speak to all the borrowers and their lawyers. And so we kind of have an idea of what's going on. So last year, if you look at the fourth quarter of last year, $150 billion of loans were coming due. 80% of those loans in CMBS, 80% of those loans had a coupon of 5% or less. So great stat, because you understand here's where we are, right?
Mm-hmm.
Everybody it's a cash in refi or cash neutral refi in almost every case. The second thing you have to start to look at is the special servicers in CMBS of what's happening with who's in special servicing. Because when loans get transferred to special servicing, it means that they need to be fixed. There's a problem, maturity default, or there's a major default, and they have to be fixed. Well, as of I think last month, 16% of all loans in special servicing were performing. Well, what does that mean? That means that they were actually good loans. They just couldn't find a seat to get refinanced or sold, and they need something. They need some help, and those borrowers should be calling me or another advisor, because you guys are getting, you asked a question before, what happens, foreclose? If the borrower senses that there's any value to this asset above the loan amount, they will take it and they will sell your loan. Doesn't that just be prepared for that? And so being prepared is being proactive and saying, no, let's not do it now. Let's wait. So you look at some of these factors, you include, and I'm getting to my prediction. You look at office is at an all-time high of defaults and late payments. What's interesting to me the most is multifamily. I was on the Deutsche Bank research, CMBS research podcast, and got a great stat last month which was between in 2023. For all CMBS loans that were backed by multifamilies, those loans in 2026 in February, 26% of those loans were 60 days plus delinquent. 26% of all loans in 2023 in multifamily and CMBS are delinquent. So that doesn't include loans that have been modified.
Right.
And that number is probably going to go up. So I think multifamilies, fundamentally, office has an issue, right? Reuse, what we're going to do with it.
It's interesting because the office market, look at the stats, the vacancies have gone down. The office market is getting more robust. It's returning here in New York City.
Here, right? I know, but when you live in Charlotte and you go and you have clients in Chicago,
gotta get out of the bubble. Well, it is a New York City based podcast.
Correct. But it doesn't, look, I don't know if that's the same case about New Jersey, Connecticut, Hartford. I don't know if that's the same. And so, I think the issue in a lot of people, and they from here own a lot. I find like a lot of people from here own a lot of things outside of the city.
Sure.
And I find that, so office itself is there's an issue, and it's got to be whether it's use and what you could do with it. We're working on and for example, we've been able to get extensions. We got an extension in the suburbs of Chicago on an office building. We've gotten a discounted payoff in the suburbs of Chicago. We've gotten an extension on Raleigh, North Carolina on an office building. So there's a lot of, every deal that is in CMBS right now is bespoke. But I will say, I'm going back to multifamily for a second. The issue with multifamily is not the product, supply demand. It is leverage, and the CLOs have a bigger problem because those loans are coming due, but CMBS does as well. So a Class C multi, where they also have ICE in the area, and they're not be able to attract tenants, and they can't put any more money to get more tenants. We're seeing those projects they don't want to foreclose because there's nowhere to sell it. So the question is, getting to the prediction is, in my thought is, once we start to see assets in volume getting sold, so somebody comes out with Class C multis, and then Class C, whoa, we're getting some traction, so let's put out the Class B multis that are over levered in the Sun Belt because they're getting hammered. Wait, they're doing it. Let's put out the Class B office buildings. So when you start to, right now, remember when I said that the loans are getting bid up because there's not a lot? Well, when there's a lot of product, they're not going to get bid up as high. Right. So again, it's who wants to take the loss when. And I think that next year at this time, I hate to say it, I think we're going to kind of be in the same situation because the government, the banks are well capitalized, and the fees that these CMBS servicers make are tremendous. And here's the thing, here's a kind of a tricky thing. A CMBS special servicer really is no incentive to quickly do anything for you, because even if they were to foreclose on you, any of the fees that they have charged will get taken off the top in liquidation and reimbursed to them. So whether you're in there, whether whatever is,
they'll keep collecting, and then if they need to foreclose,
it's a large mosquito taking as much blood as it can before it throws a carcass away. Right. And the key to this is to really have,
and I'm guessing as those fees accrue, it makes it exponentially more difficult for the borrower to figure out a way out.
It depends. It depends because if it's default interest, that's one thing, right? That's a little more fungible than non-payment of taxes or insurance. Advances are advances, and they get paid on it. And it also then depends on two things in the marketplace. One, did you put a receiver in? And then second, what's the market perception of your asset? Because once people see that you have a receiver in place, kind of like you're basically putting on notice that your property's in distress. So, I'm seeing modifications right now on some CMBS on some CMBS and CLO loans, especially in the multifamily area, where lenders will say, "Hey, buy this property from the current borrower at as close to par on the loan as you can, and we'll give you seller financing at very attractive rates and very attractive leverage." And what does that do? It's just kicking the can, because again, but if everything goes to plan and rates drop and inflation drops and rents go back up, then you hit it. But you're deferring the problem. The third asset class I'd be careful of, and depending on this market, is hotels. If we kind of think through higher inflation, which is higher expenses, companies not wanting to spend money on travel as much, especially with the technology we have now, and fuel prices of planes going up, that hotel and business travel can get hurt. And hotels, even though they went through their tsunami of crisis during COVID, the issue they have now is that a lot of them spent their PIP, their product improvement plan, and their reserves for furnitures, fixtures, and equipment on paying their debt service. So right now, when they have to go over to refinance, they're going to have to get a refresh, and they're going to need money for that, and they're going to have to find a lender who's willing to look at what their track record is, because you underrate hotels on basically on a trailing 12 or a trailing 24. So.
Yeah. Is it, what and this is not necessarily correlated to what we're talking about, but we have a lot of podcast guests talking about office, talking about hotels. Again, it's mostly New York City based, but
Mhm.
the the sentiment is at the higher end of the market, Class A office, the Ritz Carltons of the world, those are doing amazing. Like that's like
100%.
is it similar throughout the country,
Yes.
and what's the um is CMBS more likely to serve as one type of asset class versus another?
See, I always joke around that CMBS, either you've got a really good bar with a not so good asset, or you've got a not so good bar with a really good asset, or vice versa. It depends. A lot of the Class A properties get done traditionally by life insurance and by banks. And that's kind of the whole, like, if you kind of look at that, CMBS product today, the bonds that are being issued today are fantastic for buyers who are the institutional buyers, because they're getting the loans that the banks and the insurance companies would have gotten. But the biggest issue is just capacity. So if the banks don't release any of these from their books, and say they have a book and they have 50% or maybe 70% of loans that are stale and in their warehouse, they don't want to sell it, because if they sell it at a discount, they have to mark to market. So they're sitting there. Well, that gives them 30% capacity on their books. Well, now you're at 30%. Well, I've got a tsunami of loans coming in. And not only that,
This harkens back to 2008, right?
correct.
This is the parallel, because I think people who don't know a lot about CMBS, well, they might know what mortgage-backed securities are, and they've read the book Too Big to Fail,
Yeah.
or they colloquially know that mortgage-backed securities were in large part the source of the crash in 2008. So
Yeah.
so I think, is there a parallel there? Is there a worst case scenario outcome where you have the ramifications that existed in 2008? Okay.
No.
Why not?
Because we have liquidity, because the market is flush with liquidity.
Yeah.
And the issue in 2008 was liquidity. That's why things were at a discount. That's why people were fire selling things. That's why people are getting rid of it. The reason why
You also had loans that were made to non-credit worthy people.
Well, you have the same thing here. I mean, look, the home mortgages, the difference between home mortgages that were securitized and commercial mortgages that are securitized is that you can make a programmatic decision on what's going to happen with all the mortgages, residential mortgages in this pool. Nobody's going to have to pay interest for the next 6 months, and we'll collect it at the end. Everybody gets the same thing.
Mm-hmm.
In a commercial mortgage pool, you've got a peanut, an apple, a cat, and a fish, right? Like they're all bespoke. And so you have to do each one by itself. And because of the way that the bonds work, there's gamesmanship of, if you take a huge loss on something, then that controlling class holder will lose their position, so they don't want to do it. There's a lot of factors kind of going against you. I think the issue here, I don't think it's the credit worthiness of the borrower right now is more is how they represent themselves and what they're doing currently, and how much equity that they can put into the property in order to fix and remediate this problem with the help of the lender. The lender will be willing to give you the same coupon, to give you interest only, to defer some payments, to consolidate some reserves, to take the money and make it accretive, to give you some flexibility in order to do it. But you have to show up to the table with some money in order to do it.
And you have to paint
show
the right
that.
picture, which is where you come in.
Correct. The hardest part about CMBS is that there's nobody to talk to. And anybody you think you're talking to as your buddy is not. And anything you do in CMBS has to be in writing. And if you're thinking that they don't know your loan or haven't seen your loan or forgetting about you, you're 100% wrong. In fact, the servicers and the specials over the last 4 years have been going through every single loan to see what they missed and going back to collect it. So, for example, if you were supposed to have a cash flow sweep because your tenant was downgraded in their rating and they didn't do it, they're going to come back to you and say, hey, by the way, you owe us X millions of dollars because we should have been cash flow sweeping you 3 years ago and you didn't do this.
Well, I think that's a good warning and a good pitch for your services and a good place to end things. If people want, if borrowers out there are listening to this, they recognize that they're 6 to 9 months away from maturity or 6 to 9 months away from a problem, how should they get in touch with you?
Yeah, sure. So we're at Brighton Capital Advisors. It's Brighton Capital Advisors. We are based in out of Charlotte, North Carolina. We go all over the country. We've done deals from Fifth Avenue down to Florida.
If you control the whole country, then talk more about that.
Honestly, my name's Michael Cohen. I can't be the fixer because that name's taken, but I would say that if you go to our website, you're going to see a lot of case studies. We post a lot on LinkedIn and we post a lot of blogs, and I try to put out as much current information as I possibly can because I want everybody to be informed. And because knowledge is power, so that you could be a little bit more versed, but you also have to look at the loan documents. You have to have your attorney with you. We need to know there's a lot of problems where we get calls. About 20% of our calls are on administrative problems. We can't get our money out of the reserves. We're in default, but we're not in default.
Right.
And the services are not perfect. And we've been able to go back and get cash flow sweeps adjusted.
Or there's a mistake in the loan documents that you can pull that lever.
Correct. Where we're going to be, where we separate from the rest of the pack of advisors is that we've been doing this for the last 25 years of our life. And we just came out and now we're doing it this way. So we know the process. We know the documents inside and out. We know the levers. We know what you can and can't do. And we know the key decision makers in the servicers and special servicers. And now, do we go there and say, hey, I need you to look at this and go to the top of the food chain? No, we go through the system and the process. But you know what? Every time we get our deal comes, they go, well, it's Brighton Capital Advisors. We're going to work on this. And if it's stuck, we'll utilize our contacts. But we also are really good at finding the experts in the community that we need that will most effectively benefit your deal to get it done.
Well, I encourage people listening to check you out and to not wait too long.
Yeah, please don't.
Because unfortunately, if you wait too long, the only people who could probably help you are us. And that's not the best way to spend your money. So, Michael, thanks so much for being here. Yeah. And, we'll have you back on in a year to see if it's kind of a non-prediction.
I'll give you my prediction. My prediction is next year we're going to be in the same spot.
So we'll see. Well, let's take a look.
We're going to be in the same spot. If anything, what we don't want to be is programmatic.
Yeah.
Once it goes programmatic, you kind of lose your leverage. You actually want to go and try to get your deal done now.
Well, Michael, thanks so much. We appreciate it.